Hey guys, welcome to lesson number 1 of the basics of credit spreads, where I'm going to dummy proof it. If I can't make it simple for you to understand, then you should come find me and beat me up. All right, so here's the simple understanding of credit spreads. You make money with credit spreads when it stays above a certain level. All right, what do I mean by that? Okay, let's say the stock is trading like this. So now the stock price is right here. How do I make money with credit spreads? For instance, if it's a put credit spread, I'm going to make money as long as the stock stays above that level. So I'm going to be like, what level do I think the stock will stay above? I'm going to pick a level. As long as the stock stays above the level I picked, I make money. So this is for a put credit spread. I'll explain this more in a second. Now let's talk about a call. How does a call work? The same thing, but you make money when it stays below a certain level. It's the opposite. So let's say a stock is trading like this. Hey guys, just want to hop in here real quick and let you know about a free training that I'm doing here very soon. If you click the link down below, you can access it and learn how I make $3,000 to $5,000 every single month using the new Mother Credit Spreads trading strategy. I'm going to walk you through it step by step. So by the end of the training, you'll walk through knowing how to actually implement it and use it for yourself. So you can risk $25 to make $25 with a 75% win rate. So if that is interesting to you, please make sure to click the link down below and save your spot. All right, enjoy the rest of this video. The current stock price is right here. How do I make money? I pick a level I think the stock will stay below. As long as the stock stays below this level, then I make money. So essentially what you're doing here is you're just betting that a stock will not get to a certain level by a certain price point, by a certain price date. Whatever it is you want to think about it is, that's how simple credit spreads are. Now let's add some of these specifics and nuances into it. Okay, so first off, we have a put credit spread. How exactly is this structured? All right, so a put credit spread is structured by selling one option and then buying another, and I'll explain why in a second. But for instance, let's say this is the stock that we're looking at and we think it will stay above this level. This level we think it will stay above now becomes our short strike. So this level right here, whatever price point this is, we're going to find a put option at that level and we're going to sell it. So we're going to sell it. So let's say -1 because I sold it. Now let's say I'm able to sell it at, let's say, $1.20. Okay. Now a credit spread is a spread, which means that it has two different options with it, because that's the spread, the difference between the two. So because there's two things here, that's a bad at sign. We're going to have to buy the one right below it. So now we picked a level that we think the stock will stay above. We sell that put. Then we look at the strike price below it. So let's say we think the stock will stay above, let's say $400. So now we're going to sell the put at $400 and we're going to buy the put at $439, the one right below it. No, $400. So $399. So $400 and $399, those becomes our two levels. But now we're going to buy the $399. So apparently I should have picked an easier number to say. But now we're having +1 of those contracts. So now let's say we can enter that contract at $1. Okay, so how exactly does this spread games work? Well, we make money as long as the stock stays above the level we picked. That's simple. Now, how do we structure this? Well, that level that we picked becomes our short strike price. We buy the one below it as protection for our second strike price, and the difference is what we get. When we sell an option, people give us money. So this selling right here actually results in us getting $120 into our broker account, because again, every option represents 100 shares. So to get the actual price, you take whatever the price is and you multiply it by 100. So anyways, when we sell an option, we receive money. So we received $120 for this trade. However, we bought the option below to protect us, because I'll explain here how that works in a second, but we bought it to protect us. When we bought it, we had to give up money for it. When we buy something, we have to give money in exchange for it. So because we didn't sell something to someone and get money, now we're buying. Now that means that subtracts $100 because it was $1, so minus 100. So what did we make on this credit spread? Well, we made the difference. So that difference, or that spread, is $20. So the spread in the credit prices, hence a credit spread, is $20. So that means for this trade, we make $20 as long as the stock stays above our level. All right, so what is our risk? Well, our risk is the difference between these two levels. So like I said, we were using, for example, let's say we did the 400 as the level that we think the stock will stay above, and then we used our protection of 399. All right, so now we have these two levels, which are these two right here. So that's that. And so now we have these two levels. So our difference is, what's going to happen is, let's say the stock goes below our strike price, which means that it goes below the level we thought it would stay above. All right. So if it goes below it, then now we're losing. Why? Well, because that means that the one that we sold and the one that we bought are going to get assigned. So that means that someone's going to be like, hey, the contract that you sold here, I want to execute that. I want to make it worth something to me. So they're going to take 100 shares from you at this price, but then you'll have your protective option, which offsets the 100 shares. And so your max loss will be $1 because there's $1 difference in between those. However, every option represents 100 shares. So just because the difference is $1, that means your actual loss, if it goes below your strike price, is $100. However, that may be the collateral or the actual loss, but we received $20 when we put on this trade. That's $20 you get to keep no matter what happens, win or lose. Ideally, you want to win because then whatever, but I'll explain here in a second. So now we have a max loss of 100, but we received $20 when we entered the trade. So now that means that we're actually only losing $80 if our trade is below the strike price by expiration date. So that's how credit spreads are structured. We pick a level, we structure it by selling one option and buying another, and now we have a defined risk to reward trade where we know how much we're going to make and we know how much we're going to lose no matter what happens. Again, we'll explain more in the series here that I'm recording that's going to help you actually decrease your losses, know exactly what levels to pick, and all this amazing stuff coming soon in the coming modules. But in this right here, these are the bare basic bones of a credit spread. You're making money by saying it's going to stay above a certain level, and this is how it's structured. Okay, now that we know that, how do we do it on a call credit spread? Well, it's the same exact thing. The level that we pick and we want it to stay below becomes our short strike price. So we're going to sell at that level. Let's use the same numbers, $1.20, and then we're going to buy the one right above it for protection because that one's going to have less credit associated with it. So it's going to be $1. And then that's going to result in a 20-cent net return, right? Because just as we explained here, this is going to give us an $80 risk for a $20 return by picking that, and that's how a call is structured. Now, before I end this basic course, I want to say, Austin, how do I know whether I'm shorting this one or buying this one or whatever? All right, you always do it in the order what's closest to the stock price. So whatever strike you pick or whatever level is closest to the current strike price is the one you sell. The one that's further away is the one that you buy. So that's why we sold this one and bought this one. That's why we sold this first line and bought the second one. You always buy the one that's further and you sell the one that's closer. That's how you structure a credit spread for simple, easy to understand kind of way. All right, so that is dummy-proof credit spreads. I hope it made sense. Again, it will make more sense as we piece together more stuff in this module, so I'll see you in the next video.